Let's welcome on board Dipen Mehta. Dipen, I was just chatting with our previous expert as well. Democrat, Republics, what have you. The market has made up its mind and it seemed like all the aberration is already digested. Just look at the market screen today, and not just India domestically, but globally as well.
Yeah, I know. I think one major uncertainty is perhaps going to get out of the way. And although there were some fears about the US elections, but by and large, I think those have been contained. And now I think markets are looking beyond the US elections. And at least once this event is over and done with, what the markets globally will focus on is any stimulus package which may come through from the US. And that's going to be quite substantial and could have an impact on the global economy as well. Also, I think a lot of other countries, EU, Japan, China, India, also looking at stimulus packages. So while in the initial phase of the COVID-19, we were relying on the central bankers to keep the liquidity conditions extremely easy and lower interest rates, and that has played out really well. I think the next leg of the up move will come through from fiscal concessions, stimulus packages which may come from the government, and I think that's what's getting reflected in the stock prices. Also, I think globally we are seeing better than expected corporate numbers coming through, especially in India as well. I know it's the beginning of the earnings season, but by and large, I think whatever numbers have come through so far have certainly encouraged a lot of investors who are waiting on the sidelines, who are perhaps worried about the effect of the lockdown and the COVID-19 and second wave and many other uncertainties which were there. I think they are being gradually answered with the numbers which are coming through day after day, which are all suggesting that at least apart from a few select industries which depend upon the crowds to come in, by and large, I think it's business as usual, and normalcy has come in better than at least what a lot of analysts and fund managers were expecting.
Just wanted to check in on the markets right now, and lots of fervor within the broader universe as well that's being seen. Going to identify some of the names that are having a good run. And apart from those multiplex stocks, there's Brigade Enterprises that's doing well, HPCL's rather active, SAIL, Aarti Industries, Hindalco, NMDC, SBI, all of which are holding out quite smartly in today's trading session. Dipen, wanted to get in your opinion as to how exactly you're looking at the entire metals basket. Do you think that it's a prudent time to look at this sector as a long-term investment opportunity?
Yeah, good afternoon. I think the thing about metals is that there is no long term. End of the day, they are commodities and they are susceptible to many global factors and a lot of degree of volatility in the end product prices, and some of them are difficult to calibrate and understand. So as far as metals and other commodities are concerned, there is no long term. There are great trading opportunities at this point of time. And as I said, I think if a stimulus package comes through in US and elsewhere in the world, it's going to be extremely positive for metals because a lot of it will be focused on rebuilding infrastructure, and therefore it will benefit a lot of industrial metals. Having said that, I think a lot of pundits are quite of the view that the US dollar will start to weaken from this point on, considering what the challenges they have on the fiscal deficit and the trade deficit fund. And therefore, there's a good expectation that if the US dollar starts to depreciate, then that's extremely positive for all commodities because they are traded in dollars. And I think China has rebounded far better than what anybody was expecting. And now again, it is acting as a major catalyst for higher metal prices. And I think that end of the day, I think a lot of metal companies are benefiting from lower input costs, and volumes also have picked up and prices are gone, as in some instances, way beyond even what they were pre-COVID. So I think metals are a good trading, kind of a strategic trading position investors can take at this point of time. But as I said, there's no long term in metals. They've not been great value creators if you look at it historically. But right now, I think they're in a sweet spot with volumes going up as well as prices holding up pretty well. And I think a lot of metals, especially steel, the domestic volumes are picking up, and that is always more profitable for them. So yes, we are very positive on metals per se, and investors should prefer companies which have great backward linkages. So say a few with usual disclosure that we and our clients are investors, something like a Hindustan Zinc, which is completely integrated and an absolute low-cost producer of zinc. And then there is Tata Steel and JSW also. Tata Steel especially, which has got its own mines for iron ore as well as coal, so that will benefit from that backward linkage, and therefore input increases may not impact profit margins as much. And JSW Steel also is getting its raw material security in place gradually. So one should look for integrated players which have got mines also in their portfolio, so that if the end of the day, if the input prices start to rally and end product prices do not move up, at least their margins are protected.
Okay, a few other stocks maybe we can point out before we wrap up today. Some of the metal names, steel majors in particular, Dipen, on a roll as expected, of course, along with the expectations of further stimulus. But what are your thoughts when it comes to that pack and within the steel majors?
Yeah, I think we are very positive on steel companies, and so far the numbers which have come through are quite interesting. Volumes have picked up, end product prices have held up pretty well, and margins have really expanded. These are high operating leverage businesses per se. And I think a lot of these steel majors are taking advantage of this upswing to try and reduce their debt. We heard the other day about JSPL as well, where the managing director is quite clear that over the next 12-24 months, the debt would be significantly reduced. So I think steel is a good place for investors to be in, with auto doing well, appliances doing well, China also taking a good volumes out from the country in terms of exports. I think it's a great kind of trading opportunity. But investors should keep in mind that this is what it is. It can do well for a few months or so, but these are not secular growth stories. They are not stocks you can hold in your core holdings and for 3 to 5 years or so. End of the day, these prices do tend to correct because capacities will come into play and initial pent-up demand then tries to settle down. So one has to be a bit careful over there. Right now, I think valuation risk-return profile favors steel companies, but it's not that they are great long-term bets. And at best, you should trade in them with a 3 to 6 month type of an outlook.
Getting a move on then, just wanted to focus in, Dipen, as to how you've read into the quarterly numbers from SBI. Brokerages across the board have also been loading the counter aggressive price targets, but somehow the stock continues to see resistance once it does cross some crucial levels on the upside. What's the outlook on SBI? How have you read into their numbers? It is holding out above 200, but do you think that it looks sustainable in its move? And any view on the entire PSU banking lot? Are you very selective here?
See, I think by and large, PSU banks came with a very good set of numbers. And I know it could be a bit of a mirage because they still have to undertake a lot of settlement and restructuring requests, which may come through right until December of 2020. So to that extent, I think their NPA and credit costs have not yet got crystallized. But from whatever available information that they have put in the public domain, it does appear that at least the PSU banks are far better positioned to handle the surge in NPA post-COVID-19 than we earlier thought maybe a month or 2 months ago or so. And what has benefited PSU banks is surge in CASA, that's low-cost deposits, and that has expanded their net interest margins and provided them with even further pre-provisioning operating profits to take care of any surge in credit costs that may come through. So I think as we speak, perhaps PSU banks are very well placed to come out of this crisis relatively unimpacted, all subject to what the quantum of NPAs are in January when the entire restructuring period is over and done with. But you have to say that they are available at extremely attractive valuations. I think excluding SBI, a whole host of PSU banks are going at 0.3, 0.4 times price to book. These are distressed valuations. And all they need is a nice trigger, which may come through in terms of better quarterly numbers for December quarter and March quarter, or some form of reform coming through, some package, something, one doesn't really know what it could be. But if there's a trigger in the PSU banks, I think you could see a superb rally coming through to them. The gap in valuation between PSU and private sector is at the highest ever. And there's a great deal of comfort when it comes to PSU banks. Of course, they cannot pay dividends right now, but once they start paying dividends, they'll be offering a good dividend yield as well. A lot of the consolidation within the sector also is over and done with. Some issues which were there with succession planning, especially SBI, those uncertainties are also over. So I think that, I would be looking at PSUs quite closely, see what their NPAs are post-December restructuring period gets over. And then maybe one should at least try and get some allocation to PSU banks. I think the next year, that is 2021, could be a very good year for PSU banks, assuming that credit costs are contained.
Thanks very much, Dipen, for sharing with us your outlook on the markets. Real resilience being witnessed today at 12,124 on the markets. That's a solid 2% notch up.